as we enter the last full trading week of 2025, it looks like that Santa Claus rally that so many people were hoping for is slipping away from us, because it looks like markets will start the trading week under pressure. Now, it wasn't a great week last week, let's be frank. The S&P 500 was down by about 0.6%. Hong Kong market fell almost 0.5%. The ASX was up about 0.75%, largely due to support for miners. And we saw good support for gold miners, but we also saw uranium stocks doing well and lithium stocks back in the spotlight. And that support for resources across the board is one of the reasons that we saw outperformance from the Australian market last week. However, on Friday night, we saw a lot of pressure on US markets, and particularly on tech stocks. Oracle was down 13%. Intel down 9%, Broadcom down 8%, and these formerly glamorous tech stocks appear to be under renewed pressure as they closed out the week, and that, of course, dragged the markets down. So the Nasdaq, the most affected with that pressure on tech, it was down almost 2% at one stage during the session, finished slightly better than that, but both the Dow and the S&P 500 fell as well. And futures indicate we're off to a very rough start to trading this week, with the Australian market tipped to open down 0.5%. Hong Kong today tipped to open down 1%. And in Tokyo, we're looking at a fall of 1.5% at the open, at least according to the futures markets. But looking ahead, there is data to guide us. Today, we'll see industrial production from China. Could be very important for the global industrial outlook. But the big number this week is likely to drop on Tuesday night our time, and that is the non-farm payrolls for November. Now, you'll recall that we had an interruption to this data series because of the shutdown of the US government. The October data will not be released. They won't be recalculating that one. But the November number becomes very important because of that lack of information about the state of employment in the US. And at this stage, the forecasts are pretty cautious, looking for 50,000 new jobs in November and an unemployment rate of 4.4%. So if it comes in line there, that I think will encourage further talk of potential interest rate cuts next year, and that could be supportive for shares. But a stronger read is a real risk here. If we were to see a number north of 100,000 new jobs in November, some might argue that takes interest rate cuts next year off the table in the US. In a similar fashion to Australia. And if that's the case, we could see a significant reaction in the share market, something to watch out for. We'll also see inflation data in the US this week. On Thursday, CPI data is released. Of course, in this current environment where interest rate speculation and expectations are very important drivers of the share market, the inflation read on Thursday night could also be influential for the US markets and therefore the globe. Turning our attention, though, to gold, we've heard from the World Gold Council. Now, some traders might argue that the following statements are in the category of they would say that. They are representatives of gold producers, but nonetheless, you won't be surprised here they've come up with a number of scenarios for gold in 2026, and two of them are quite bullish. That's despite the fact that gold is currently trading above $4,300 an ounce, and within $100 of its all-time high. The Gold Council does concede that in a inflationary environment with a stronger US dollar, there might be a turn towards risk assets generally and globally, and that could see gold prices come under pressure and fall in a range of 5 to 20%. That's their bear case. They believe if rates are lowered or if the US economy is soft, and it looks like rates might be on the way down again, they're likely to see modest gains for gold prices with a lift of 5 to 15% from current levels. And if there is geopolitical stress, according to the World Gold Council, and falling yields in response to that geopolitical stress, gold could rocket up by 15 to 30%. Now, that's a very bullish scenario. As I say, the World Gold Council, representing gold producers, does have a vested interest in seeing higher gold prices, but nonetheless, they are officials in this space, and that's the three scenarios they're looking at for gold prices in 2026. And while we're on gold, we'll turn to our watch list. One of the top performers in Australia last week was Emerald Resources, and the gold producer was up 5% on Friday after releasing a drilling report that showed a very important production possibility. They're looking at significant gold production in 2026, and their goal is to produce between 300 and 400,000 ounces. They were the biggest gainer on the ASX last week, up 14%. And on the Moo community platform, they have a buy rating. Emerald Resources, one for your watch list and on mine. Another on my watch list today is Lululemon, up almost 10% in trading on Friday. Now, Lululemon shares have been under extraordinary pressure. They've fallen from above $500 a share to below $200 a share. So it's coming from a much reduced level. But the big news on Friday night was that the CEO had resigned. And it must be very disappointing for that CEO, but the share price rocketed higher in response. The business is challenged. There's no two ways about it. However, revenue does appear to be turning around at $2.57 billion for the quarter. It beat estimates. However, even at these reduced share price levels, analysts have a hold rating on Lululemon, but its much reduced status might be attractive to some looking for value in the share market. Lululemon trading near its lows still, even after a 10% rally. And just as we saw last week with IBM gaining attention, the old school tech attracting investment interest, Cisco last week reached a new high. Now, Cisco previously hit its high at $80.25 in the year 2000 in the dot-com bubble. And it's taken 25 years for Cisco to beat that high water mark, but here it is. Traded very strongly on Friday night. Big recovery, of course, from the dot-com crash where it lost 90% of its value. It's now back and looking to reach 61 billion by the end of July in terms of revenue. And Cisco Systems also has a buy rating in the movement.